GM everyone. If you're with us, thank you so much for joining and joining in early. So we would wait for like an extra 2 minutes. In the meantime, feel free to tell us where you're joining in from in the comment section while we wait. Hello everyone. So I'm Onye Bazi and thank you so much for joining us for our live session. Okay, so we have a fascinating session ahead, one that bridges two worlds, traditional finance and on-chain data. Before I introduce our speaker, let me quickly acknowledge that we are live on YouTube. If you have questions, drop them in the chat. We'll get as many as possible during the Q&A. So if you can still hear me, feel free to share an emoji in the comment section so I know that you are following. All right, we have Big Bright joining us from Nigeria. And to the rest of you, thank you so much for joining. Today's speaker is someone who has worked both sides of the aisle in terms of traditional finance and crypto. We have with us Mr. JW, and he is the co-founder of Nexus Data,
Hey, how are you guys? Can you
formerly
guys hear
at
me?
Galaxy. Yes, we can hear you, sir. Formerly at Galaxy Digital and has over 8 years of TradFi experience. He is also a CFA charter holder. His on-chain work is public at Dune.com. And today he's going to help us answer a question many analysts are asking. When you bring TradFi valuation frameworks on chain, what works, what breaks, and what surprises you? Please join me in welcoming Mr. JW. Sir, the floor is yours.
Hey, how's it going? Can you actually admit the JW screen so that I'm sharing there? Yeah, there we go. Can you guys see it now? Let me know when you guys can see.
Yes, sir, we can see your screen.
Okay, nice. So let's get started. So yeah, thanks for joining everyone. My name is JW and I'm a co-founder and advisor at Nexus Data Labs. So before moving into crypto, I spent time at TradFi hedge fund focused on asset-backed securities and fixed income for about 8 years. And now I've mostly focused on on-chain data and research. Few housekeeping points. Everything today here is educational. Nothing here constitutes investment advice. And I'll share frameworks and opinions, but none of these are recommendations. And if you find this presentation useful, follow me on X, JW underscore Soul, and the Nexus Data Labs. And any feedback is really genuinely helpful for us. So, let me know if you have any questions. And today we're going to walk through what transfer from TradFi, where traditional finance frameworks break down in crypto, and how to approach valuation when evaluating on-chain assets. So let's get started. So let's start with the golden rule of valuation. So it's garbage in, garbage out, right? So every model is only as good as the inputs you feed it, even though you have a perfect model. And even though you have a perfect data, which you and I all know that they don't exist. And if the model is imperfect, you will get a garbage result. And in TradFi, you have three things working in your favor. So first, audited financials. Second, universe of a comparable public companies and years of a transaction data. And these inputs are imperfect, but they are standardized and then third-party verified. And in contrast, in crypto, most of those inputs are either missing, unaudited, or actually gamed. So here are some examples. First, the audited revenue. I mean, I know some companies are getting audited, but protocol fees, token emissions are usually mixed together and they're not fully audited. Also, there are no clean peer groups. So there's no agreed methodology what category a protocol belongs to, although you could probably guess, but it's your guess is as good as mine. And there are no reliable M&A data. Most deals in crypto tend to be talent acquisition, not an asset purchase. And the user data, they're bots, Civil Wallet, airdrop farmers, they all kind of active addresses, and TVLs are inflated. In that sense, the framework is not broken, but the data fed into it often is. And let's keep that in mind for every slide that follows. And let's move on to the next slide. So when you go to business school, start working in finance, they teach you, these are the main methodologies that they teach you. Every analyst should be fluent in all three. And these are not meant to be used by itself. Most of the times it has supposed to be complement each other. So starting with the first, you guys probably heard this so many times, being in crypto and word finance, discounted cash flow, which is commonly known as DCF. So DCF projects the future free cash flow a business will generate, and then you basically discount them back to today using a risk-adjusted discount rate called WACC, which stands for weighted average cost of capital. So the core idea is that dollar in the future is not worth the same as a dollar today, given inflation and risk. So basically, you have to discount it back to the present, where for what the company and protocol will make in the future. And here, the discount rate also varies by industry and the company. So early stage companies carry extremely high discount rates given the uncertainty, and the most of crypto projects probably fall into that category. And however, DCF is usually generally used as a golden standard that gives you more intrinsic value. However, only works when cash flows are predictable, and then you can defend your discount rate. And so we go to the next methodology, which is a relative valuation. So this method basically compare assets to peers using multiples like these are some fancy words like price to earning, enterprise value to EBITDA, and price to sales. Depends on the industry. And if you break it down, essentially you're asking, what is market paying for the similar businesses? Where are they pricing them? So that's, we could use all these fancy words, but that's essentially what this valuation methodology is asking. So usually this is fast and intuitive, but it's only as good as your comparable set. And then moving on to the next one, you're looking at transactions here. So this basically methodology looks at what acquirers actually paid for the similar business in real deal. So it looks at recent deal that actually happened. So for example, this happens a lot in, kind of more day to day. It's like real estate. If you buy a house, your price your price point anchors to the recent transaction. What was a similar apartment or a similar house that was sold in the area, recently? And just because someone lists the house next to mine and lists at $1 million doesn't mean the house is worth $1 million. It's actually this, you actually need a buyer who are willing to pay for that. And this methodology basically assumes that the market is efficient and then the rational buyers pay a fair price. So in practice, this, you basically triangulate all three methodologies and try to come up with a valuation number. And, if they somehow converge, you generally have a conviction, or you can basically say that, oh, these might be the more fair price using all the recent data points that I have. And if they diverge wildly, you have some questions to answer or dig in, time to do some research. All right, so moving on to the next slide. So let's apply these to the crypto or blockchain industry and see where they break. So let's start with DCF, which is one of the arguably the most respected method in TradFi. The first problem is most protocols have no stable revenue to project forward. So revenue in crypto is often incentive driven, so and then tied to the market condition rather than actual business fundamentals. At least not yet. And even when fees do exist, they frequently flow to liquidity providers or stakers rather than a protocol treasury. So if the protocol captures nothing, there's no cash flow to discount. And the second problem is discount rate. TradFi, you anchor your discount rate to a risk-free rate, typically government bond yields. So, you're looking at US treasuries or whatnot. But in crypto, there's no equivalent. So there is, I guess you could argue that maybe some ETH staking rate, but it's not standardized, and there's no 10-year ETH treasury bond. So without the anchor, discount rate is largely a guess. And now, if you add the token emission on top of that, you can basically strip out what the real revenues are to what's the actual revenues are, or the artificially inflated volume due to incentives. So, I think the clean test is like looking at one of the framework you should look at is like, okay, like if you turn up all the token rewards tomorrow, how much activity remains? And the most DeFi protocols, probably the honest answer is most of it leaves. We've seen that recently in many different protocols, not to name any protocols here. And next, moving on to relative valuation. Basically another problem here is the peer group problem. So take Aave as an example. Is this a bank? Is this a fintech lender? Is this a money market fund? Or is this a decentralized financial protocol? So each of these categories carry like a different market multiple that you can apply. So for example, fintech companies, let's say they trade around 5 times revenue. SaaS companies might trade at 15 times, and some of these other categories might trade even like lower. So you will get these wildly different valuation based on which category you assign it. So you do need to make an assumption here. And then lastly, you're looking at the recent transactions. This methodology actually requires actual asset purchases, or you need to be able to produce a price multiple. And most of crypto M&A, or when they sales, they don't really meet that bar, since most of these deals are acqui-hire, where companies buying a team rather than business or intellectual properties, or like ecosystem play. Maybe large protocol might try to buy the smaller one to get the liquidity or users. So for example, like Coinbase acquires a team, and they're basically paying for the engineers and then the IP, rather than, they're not trying to buy the revenue, at least not yet. It might change in the future, but not that I haven't really seen. So without that, there's no real transaction database to draw from. And so the point of this slide is, it's not to throw these framework out. It is to be honest about where they stop working, so we can build something more reliable on top of them. All right. So moving to on-chain metric layer. So these are the 4 numbers that you'll encounter most in crypto analysis. So, excuse me. Sorry, excuse me 1 second. So these metrics are, I brought them here so that we know what each one measures and where it stopped being useful. So starting with TVL, I mean, this is probably the most cited metrics in DeFi and one of the most misunderstood. This basically measures the capital deposited into the protocol, not the capital that is actually working or generating return. So this is a very high level metric. So for example, protocol with 2 billion in TVL with might have a minimal fees and revenue. It basically just money sits there. And then some of the protocol with the less TVL might generate more revenue than the protocol that I mentioned previously. So, and also the problem is TVL is really easy to inflate with token incentives, right? Protocol pays users to deposit, the number goes up, and then once the incentives gets removed, the capital leaves almost immediately. So one of the way to approach this is basically, don't use TVL in isolation. So you always pair it with the fee revenue or utilization rate, how efficient these capitals are getting used, and using these different metrics to understand whether the capital is actually productive. And next one is daily active users. So this is another headline metrics that is widely cited in protocol dashboards and investor decks. And the problem is this is also easy to gain, right? There's like civil wallets, bots, airdrop farmers. They all show up as active addresses, and it's really hard to distinguish between a genuine user and a bot, like a bot farming rewards. And one of the I've done this analysis before from looking at the on-chain data perspective. You can try to filter these out, artificial users, and basically looking at, okay, like how many transactions is this wallet doing? Like, is this like something that is humanly possible? Is this a bot, or is this, just are they returning? So you have to set certain assumptions and to figure out, okay, like how do we filter out these wash traders or airdrop farmers? And I think this is a problem in crypto, especially where a single person can run hundreds of wallets and generates, basically hundreds of daily active users at almost no cost. So, I think another approach would be looking at these numbers more in a trend, where like it's 30-day trends or is it 60-day, or the question to ask here is like, are they fee paying, or are they here because someone is paying them to be there? So I think this is like some question to ask looking at looking at the daily active user metrics. Moving on to fully diluted valuation. So this is a market cap that's on a total token supply, not what's circulating. So this distinction matters. And then usually retail analysis they're looked over. So for example, token with a 500 million market cap, but there's a 5 billion FDV, which means 90% of supply has not hit the market yet. So whenever there's a unlock event in the future, it's going to be a sell pressure. So it could be early investors, team members, or basically ecosystem funds. They have all these vesting unlock schedules. So you have to look at, when you're evaluating these protocols, you have to look at FDV alongside with this unlock schedule and emission schedule, so that make sure those are the risk, potentially huge sell pressure coming in. And also, moving on to the next one is token concentration. This also follows a fully diluted valuation, right? So basically, high concentration in a small number of wallets basically compound the issue of the fully diluted valuation, where if handful of the wallet controls most of supply, they might exit and might move the entire market. And moving on to token concentration, this is a metric, I don't think I think people should talk a little more and more about it, and we maybe need some sort of a metrics. And then basically it measures how ownership is distributed across wallet. So another useful metrics that you could probably use from TradFi is called the Herfindahl-Hirschman Index, HHI, which is basically borrowed from when they do the analysis from antitrust economics and measures market concentration. But this could be also used in how many wallets are controlling a certain portion. So concentration of these ownership create like let's say two risk, right? First, exit risk. So if there's a one whale, they start selling, and they basically translate into a immediate price dislocation. And second, governance risk. So concentrated holder can push protocol to decision to in their own interest rather than the broader communities. So I think there is another issue with that. Um, so taken together, we need to look at various metrics in aggregate. You can't just look at one metrics and say, oh, like TVL is, really high past this number, like this metric, this protocol is doing well, like daily active user past this amount. But like, I feel like this is what's mostly talked about in crypto Twitter, where they're focused on the single dimension rather than looking at these various metrics in aggregate altogether. So putting this all together, I mean, I can confidently say that there's no single framework that will give you a clean answer when you value digital assets. We don't have a universally agreed valuation methodology for crypto assets yet, and I know people are trying to bridge that gap by um, bringing methodologies from TradFi or using some metrics that are more native to crypto, but we don't have that specific sets yet. And what we do have is a set of questions that basically might separate the serious analysis from the noise. So let's walk through some of these, starting with protocol revenue. Personally, I would start here before looking at anything else. So let's say protocol has some revenue, and then I'll try to strip out the token emissions from whatever revenue figures you're looking at. So, and then like because a protocol needs to generate a fee without paying users, and I think that's a genuine potential free cash flow in the future. And I think the question here, Jen, a lot of times is it's not about how much revenue the protocol reports or what you see in the dashboards. It's more about, okay, like after once the incentive stops, how much of this survives, and is this more sustainable? I think when we're looking at some of these protocols, we need to look at the more of a sustainability. And that bring us to next one, retention. I think like is this this is more borrowed from like a SaaS investing, and it is one of the signals about the product market fit. So we can look into, are users still active after 30 days of the first transaction, 90 days? So like, are they coming back to use this protocol? And also critically, are they actively using this protocol without being paid to? I think retention generally is hard to fake. You can manufacture active addresses and have a short-term boost on activities, but I think it's hard. It's genuinely hard to manufacture user retention after like a 90-day over period or even longer period. So that's another metrics to look into it. And moving on to more of a qualitative layer. I mean, this is not there's no like a specific metrics. You got to look at founders and token structures and protocol specific due diligence. So looking at the founders, you have to look at their prior track records. Are they docs team, or do or are they anonymous team? I mean, these are all very qualitative, but something you have to look at to dig deeper into the protocol. And also token structure. I mean, we briefly touched the FTV, right? So what is currently in the market versus what is a full token supply that hasn't been unlocked, and then what is the schedule of unlock? Are they gonna, or is there gonna be, I mean, I'm being extreme here, like a 90% unlock in the next 6 months? I mean, and then once that day hits, we might have people who hold these locked tokens might sell. I mean, very likely, right? They have to. That's part of their compensation a lot of times, or they have to get basically funds have to get paid for their cost basis. So, they have to generate return. So likely they're going to sell. So you have to look at the token structure, or digging into protocol specific. You have to look at product market fit, starting with the basic question, like, will I use it? Or if I don't personally use it, do you think someone who might fit their audience, do you think they are going to use it? And strip away the incentives and ask like whether this product actually solves a problem. Looking at the security, I think this is brought up a lot recently. I mean, I don't think generally a lot of people don't have a skill set to look at smart contract risk directly. You can say, oh, like that's safe or not, but I generally tend to look at how if they have been exploited, like how do they respond? Like if they're that response kind of tells you a lot about the team than the exploit itself. And or looking into like I think check they're audited or not by the reputable firms. I mean, I know a lot of other firms are there and then just still get hacked, but that's some like it's more of a check mark. You can check out if the smart contract has been audited or not. Or something like is there a bug bounty program, right? Like if you want to check if they're actually taking the smart contract list seriously. And another one is more of a competitive moat. I mean, like, in traditional finance or, just industry, other industry in general, the moat comes from the branding, regulatory barriers, or switching costs or network effects. So, crypto, the question is a little more simpler. Like, what stops a fork from taking that liquidity tomorrow? I mean, looking at Uniswap to Sushi Swap, like, I mean, they forked the Uniswap's code overnight, and then, but Uniswap survived because of the brand and the developer ecosystem, not because of the code. So that's something we want to look at also. So, bringing all these together, I don't believe there is a golden framework, for any valuation, right? I mean, a lot of times it's more of an art than a science where you have to figure out, you have to make certain assumptions, you have to understand the business, how that applies to the specific company, protocol, or token. And the edging crypto valuation is like not having um, because there is no sophisticated model. You have to ask a lot of these questions, and that it is actually knowing which data to distrust or trust, which question to ask, and then figure out which signals are organic versus is incentivized. So, I think it's the integrity of inputs and the data. It basically determines the entire valuation. And I think this is something we need. I don't think there's no golden rule, no golden framework yet, but I think something we need to discuss and talk about as an industry rather than looking at a single set of metrics and say some of these protocols or some of these companies are thriving. I think that's something we need to work to thrive on. So yeah, that is the entirety of the presentation, and I'll open up for any questions if anyone has any. Any questions? All right, no questions. Then I just want to say thank you, and feel free to reach out if you guys have any questions. Um, I'm trying to potentially write about it a little bit, so maybe I'll just put this in like an article form or something. But feel free to reach out if you guys have any questions. Thank you very much, guys. Enjoy your Saturday evening, afternoon, wherever you guys are. Thank you. Oh, how can we reach out? So you can follow me. Let's see. You can follow me on X. You can reach out there. I think the slide was showing it, JW_Soul or Nexus Data Labs. Feel free to reach out on those two, and then yeah, I'll answer. All right. Thank you very much, guys.